It might be good because I tend to wander, and if I wander too much here, I'm going to be in somebody's way, pretty much. So, yeah, that would be perfect, I guess. There we go. I'll try to get on it somewhat so that so I'm not walking in front of where everybody's trying to look. So my name's Gary Aker. Jerry's right. I got my start here. I was actually here for about a year and just learning, didn't know a lot about the real estate market. I was actually 24 years in the military, and then about 5 years corporate medicine. And then we moved down here during COVID, when my father-in-law was in the ICU, very sick. And thought I'd be able to walk into another medical job, found out that down here, they don't want somebody with 30 years of experience in medicine. They want somebody with no experience that's willing to work for $30,000 a year. And I was like, okay, so we're pivot. And we read Rich Dad, Poor Dad, and they talk about real estate investing in there. And so we sort of made that switch. Our first classes were actually the ones that we paid 40 grand for. How many of y'all done that? Paid $40,000 for courses? Yeah. So the first classes that we took were about tax liens. And tax lien code. You see them advertising. They still advertise for their free courses. The first one's free, the next one's $1,000, and then the next one's $25,000 or $40,000. Which one do you want? We never did finish the package. They still email me saying, "When are you going to go to your multifamily class?" I was like, "No." So, but yeah. So we learned a lot there. Sort of had the shiny object syndrome for a while. I thought, well, we're going to try this, and then let's try this, and then we'll try this, and never really got much places. But I was right here in this very room about 3 years ago when Walter Amarello showed up, the founder of Alchemist Nation, and said, "Come to our summit." Our summit's just in Orlando. It's called the 100 Millionaires Summit, and this was in 2022. And he said, I told Mary Lynn, I'm like, we're not going no more conferences until we start making money. And then he's like, but I'll give you free tickets. He gave us free tickets. You just got to pay for your hotel. All right. So we went, and I said, we're going to go, but we're not going to buy anything. And because it's going to be a sales pitch. And so we held off for like 3 days without buying anything until we finally bought in. But it was only $10,000. That was the best $10,000 we spent in real estate because what they taught us was how to network. And they taught us how to build networks and so how to run my own meetups and things like that. So I started running meetups. Greg actually asked me to host one of the TB-RIA. So we hosted the South Hillsboro TB-RIA, which last month they just had their last meetup in Ruskin. And that's because they decided to shut it down because we went for 5 months with less than 5 people there. And on the very last month that they were going to shut it down, they had 25 people there. Can you believe that? So, but I think they still made the decision. They'd already made the decision to cut it off. We're trying to consolidate because some of these meetups out here are getting more people than the main meeting are getting. The main meeting's getting 25 or 30 people sometimes. And if you guys are coming to these subgroups, you really should head over, once a month and try to hit the main meetup. Because it's valuable also, and you get a broader perspective. You'll get a lot more people in there. So,
let me interject.
Go ahead.
I will be the speaker.
Well, there you go. So you got to go for Jerry. Yeah. So, but yeah, and then so when I started running meetups and started building a network, and I learned how to use the network to bring value to other people, man, things just started happening, and people started bringing me business. People started bringing me deals. Every deal that I've ever done or that I'm currently doing is something that someone from my network brought to me. I'm currently in the midst of building a house out in Indian Rocks Beach as a total tear down, and my network brought it to me. I didn't go searching for it; they brought it, and the people that are invested with me in it they brought it to me. So I'm now a 1/4 owner of Alchemist Nation. And I was their brightest student, and so they made me an owner. And I'm also a 1/4 owner of the Alchemist Nation Growth and Income Fund. We do run a multifamily mastermind, which actually meets tonight, so you might see something popping up on here reminding me to go to my mastermind meeting. But so we do run a multifamily mastermind, and it's sort of a natural outgrowth of that is our fund. And since I became a fund manager through that, I really had to start studying SEC and what does it mean to raise money and do it the right way. And I will tell you this, everyone has heard the phrase, don't use your own money, use what? OPM, what's that? Other people's money. Do your real estate using other people's money. But they never go into the right way to use other people's money. You don't see that very often. And so I'm glad we got some people that are doing lending into real estate, because it's important for you guys to understand the right way, because you want to know if you're doing lending on real estate. I know, Mark, you do some lending and stuff too, right? If you're doing lending into real estate, you want to know that the person that you're working with is doing it legally and that they're not cutting corners. Because if you're lending to people that are cutting corners, your money's at a higher level of risk than you think it is. Okay? And I will say this too. One of the first deals that I got into was actually a private lending deal where I took two people in my network. A guy brought me a deal and said, do you have someone that has money? I've got a deal. I said, show me the deal. He showed me the deal. I took it to somebody I knew had money, and they said, I want to be in this deal, but I don't want to mess with it. I want you to do that for me. And I was like, hold up. I got to call some lawyers and find out if that's legal. It turns out in Florida that's perfectly legal. You don't have to have a license or anything. If it's commercial or investment properties, it's just a contract between you and whoever has the money. And so I actually started doing some private lending and making a little money on the side doing that, and learned a lot. So I've learned a lot about the lending business. And then when I became a fund manager, I started learning the legalities of it and found out that some of the stuff that I was doing wasn't quite legal. I was like, whoa. But the problem is they say use other people's money, but they don't have a lot of classes for how to do that the right way. And so I just want to bring this to you, just add some value. It's funny, I was doing a little bit of studying on this just this afternoon, and I ran across the phrase that said there's 4 types of people that don't raise money by SEC rules. Okay, it's the people that don't know, or the people that don't care, or the people that are fooling themselves and think it doesn't apply to them, or the people that are in jail. Those are your 4. So which one are you? You're not, after tonight, you won't be the person that don't know anymore. Okay? So the other 2 might be you don't care, or you're fooling yourself. Let's hope it doesn't come to the jail, right? So I'm going to talk to you. I will tell you about our fund. And since I'm talking about our fund, our lawyers have reviewed all of this. The lawyers make sure that this disclaimer is on every piece of paper that we have, our fund. And basically they have a lot of different ways to tell you could lose all your money. That's basically what the disclaimer says. And every disclaimer about any legally run fund will say the exact same thing. You can lose all your money. And then also past performance is no guarantee of future results. That one's always on there too, right? So this is our management team. Gualter Amarello, Gualter, real estate investor. He went to Cleveland. They were down here in Tampa, said, I've got to move to Cleveland and I'm buying multifamily. He moved in December of last year. He said, before my birthday, I'm going to have 200 units under contract. Before his birthday, which was February 22nd, I believe, he had 362 units under contract from December to February of 2025. December 24 to February 2025. Currently, we have about 508 units under contract right now, and we've got another 300 units under agreement that we should add to the portfolio by the time of the summit, which is in October of this year. And then another 200 units that we are looking at for fourth quarter acquisition. So in 1 year, we hope to have acquired 1,000 units, and the goal is for next year to put another 3,000 units. And just if you're interested in seeing the type of units that we're getting, they just did a YouTube documentary on us, and it's called "They Only Invest in the Most Dangerous Cities in America." I don't know if you saw that. If you see it, if you go to my website, GaryAker.com, GaryEaker.com, I've got a button there that says "We only invest in the most dangerous cities," and it'll take you right to that YouTube video. So Gualter's our main operator. Dr. Brian Kent, he's also from Tampa. big time investor in this area, author, speaker. He does a lot with government contractors and helping people get into government contracts. But he's a long-time real estate investor and angel fund investor, and he's on our board. Greg LeBlanc, he's our acquisitions manager. He's always out there scouring and making offers. And this is a key for acquisitions managers. If you want to be in acquisitions, what do you have to do? Where's our wholesaler? What do you have to do? Make offers. So many people, especially in multifamily, they go through these courses and it teaches them how to underwrite a deal. And they will spend days and days and days underwriting a deal and they never make an offer. Meanwhile, I've made offers on 15 deals in the time it took them to analyze one deal, because I can analyze something in 30 seconds. I'll tell you what my offer is going to be on it, because the offer is just to get somebody talking. And if you know that they're not anywhere close to your ballpark, and there's not even worth having a conversation, it's definitely not worth spending 3 days trying to underwrite the deal anymore. But anyway, Greg's putting in like 200 offers a month on different multifamily deals between 50 and 100 units. So, and then myself, I am actually the least experienced as far as real estate that's on the team. My experience is mostly in leadership and managing organizations and doing a lot of the back end stuff. So I'm like the administrator. I'm in the platform all the time. I'm in the CRM all the time and making those things work together. So, so the AGIF Advantage, it's Alchemist Growth and Income Fund. So you'll see AGIF abbreviated there. So we offer three. Right now we just have straight debt offering. Okay, and the thing that's nice about our fund is we are actually in a customizable fund where we can put equity deals in there, but right now equity is just not the play that we have right now. So right now we're just offering straight debt based on how long an accredited investor wants to loan us their money. So for 6 months we pay 7% back. For 12 months we pay 9% back. And for 24 months, we pay 12% back, paid out on a monthly basis. So you have to be an accredited investor, and this is the only reason I can talk to you about this, because it's a 506c fund. We'll go over what that means here in just a few minutes. But it's simple. It's just simple interest. It's like an interest only bearing back. But at 12%, that's good, paid out monthly. So $100,000 in, you get a check at the 15th of the next month. You get a check for $1,000 goes for 24 months, and then you get your $100,000 back if you want. So it's cash flow play. We don't expect that people are going to empty their whole portfolios and invest with a fund like this. It's meant to be a supplement into types of funds, right? But we do invest for social impact, and I will tell you this: that one of the things that we're doing is if you go and look at that video on my website. We are investing to help people who don't want to live where they live. They have to live where they live because they can't afford to live anyplace else. And when Walter went in, he was looking at one of the units in Cleveland, Ohio. He went in right after he moved to Cleveland in January. It's 20 degrees outside. He walked into the building. It's 20 degrees inside the building. The heat had been out for two weeks. They go in. The families have shower curtains in their kitchen and their ovens open, with a family in there with little kids. Okay, Walter was like, we have to take over this property. They need us. And I've told a story about, but the guy that had invested in the place, the guy that owned it, he was this rich tech dude in Boston, right? And what did he do? He's like got several $100,000 sitting around, and he goes to one of these multifamily events, right? And what do they tell him? Oh, if you want passive income, just invest in multifamily. That's passive income. And you hire your property managers, they take care of everything, and you just collect the checks, which is what he did. And he collected the checks, and he had a bunch of property managers that he didn't manage the managers. So what do? They just did whatever they wanted to, right? As little as they had to. Things started going downhill, put off your different maintenance and all this kind of stuff. And all of a sudden now the checks stopped coming. And now it's a brain suck, because now he went from 90% occupancy to 45% occupancy. And so this guy didn't mean to be a slumlord. It's what he became, just from inattention. And so we went in, took over those type of things. We look for those kind of properties so that we can come in. We're revitalizing neighborhoods. Yeah, we go in they're rough neighborhoods. If you go to that video, he talks about how he had people walking across his in Jackson, Mississippi. He had people walk across the parking lot with assault rifles in their hands, out in the open. But what do? We hire security guards. We get people to clean the place up. The security guards get known to every door. Every door gets knocked on every day by a security guard. Hey, is everything okay? Can we help you with anything? And then that makes it real easy to collect the rent too. Because the security guard comes by there every day. Now he comes by on the first and goes, oh, by the way, I'm here. I can take your rent check down to the office for you if you want. Yeah. So increases the ability to collect rent and stuff like that. So anyway, so I don't want to spend all my time on that. I will tell you a little bit more about the fund towards the end. What I do want to talk about is raising money legally. Why does it matter? How many of you know what can happen if you get caught by the SEC raising money in an illegal manner? Fine. You can be fined. What else? Jail. You can be put in jail. Yeah, fines, and all of your money has to be paid back that you raised illegally too. Your reputation. Right. Here's another thing that I didn't realize until I became a fund manager. Every person that wants to invest in our fund has to go through a background check. Okay, now we can only take accredited investors first, but when they go through a background check, what are they looking for? Do you know? Financial crimes. Right. So if you get a ding from an SEC that you've got a financial crime problem, then as an accredited investor, you lose tons of opportunities. Guys, if you're not an accredited investor, you don't understand that accredited investors have opportunities to invest in just deals that would make your mind blow. It's just crazy deals that are not available to the regular public. And so, but you lose that opportunity because if people are raising money legally, they cannot raise money from people who have these financial crimes. Okay, so that's there's some things. So there are a couple of exemptions to the SEC rules. So most securities, which are like your stocks and bonds and everything like that, that gets all registered and it's monitored by the SEC, right? The SEC put together some exemptions which allow small businesses to be able to raise money easier. So we don't have to go through the whole stock market thing, have brokers out there selling securities for us and all that kind of stuff. So the exemption that we deal with in real estate are Regulation A and Regulation D. Regulation A, those are those big crowdfunding things like you hear on Bigger Pockets, you can invest with us for as little as $10 down and blah, blah, blah. You know, y'all have heard that? Anybody heard that? Those advertisements? I think Grant Cardone has a Reg A. It's where you can invest as little as $10 with them. Those are all Regulation A. They're allowed to be advertised freely. You can take accredited and non-accredited. You don't have to have minimum investment amounts, but they are highly scrutinized. Okay, now they're not registered, but they're scrutinized like crazy, right? This Regulation D is what most of us are used to using. If you are raising, how many of you have raised money for a real estate deal? Okay, if you raised money for a real estate deal, or if you do today, you used Regulation D, okay, or Exemption D. So Reg D allows companies to raise funds without the full registration process, making it easier for small businesses to access capital. And then Reg D ensures specific protections for the investors, and they do this with two rules, 506B and 506C. And then there are some more exemptions and stuff that go underneath those two rules. Here's the thing. These are all self-done, okay? They're self-proclaimed. So if you're raising capital under Reg D, it's up to you to follow the rules of 506B or 506C. And it's not until somebody looks into it that anybody's going to say anything. But there's a big whistleblower thing with the SEC. And of course, if somebody goes to court, then that type of stuff can get looked at, right? So if one of your deals falls apart, I don't want to sit here and on my high and mighty horse and say, oh, you only raise it legally, because I know, we all know how this works, okay? I've been doing this long enough that we know that you've got investors who will come in and put money into a deal on a handshake. or a text message. Jerry gets his by text messages, right?
I get confirmation.
Exactly.
I still sign paper.
Exactly. So, so we know how this goes, but all I'm saying, I'm not saying, and most of the time, for SEC is not going to look into these small deals that most of us are doing. You know, if it's under $1 million, under $5 million, the SEC probably doesn't care, right? Until it goes to court or something happens, right? Somebody puts a whistleblower. So I'm not saying that everyone's going to automatically change everything that they're doing, but we should be aware. We should be aware. And really, the regulations are not that complicated, but they're there for specific reasons. Now, the one I want to concentrate on is the 506B, because everyone calls this the friends and family exception, okay? I want to tell you something. If you look through the SEC's guidelines, there's no such thing as a friends and family exception. It doesn't exist. You're either raising money under 506C or 506B. And when you raise money under 506B, you're supposed to do it the right way. So a 506B allows unlimited fundraising, so there's no limits on the amount that you can raise. But if you have non-accredited investors, it does limit to 35 in one deal, okay? So 35 under Rule 506B. And non-accredited investors must meet certain sophistication criteria. In other words, they have to be knowledgeable enough to understand the deal and understand if it's a good deal. Or they have to be advised by a licensed advisor that is knowledgeable enough to be able to tell them. Yeah, Mark.
I don't know if everybody knows, but maybe explain what a accredited investor
I was thinking the same thing.
I'm getting that. I got a slide on that. One step ahead of you. All right, so these are the different comparisons. So Reg A, that's what we were talking about. Those are those ones you hear about on the radio. Invest for $10. You know, Reg D 506B, 35 non-accredited, unlimited number of accredited. No limits here. Notice it's minimal disclosures for accredited investors, but for non-accredited investors, the disclosures are rather extensive, which means you have to provide a good amount of paperwork to them saying, what does all my paperwork say? You can lose all your money. You could lose all your money, right? And then there's marketing rules. So you cannot do general solicitation under 506B. So you actually have to have a documented relationship with someone before you can present the fact that you're raising money. So that would mean, for instance, I met you on Facebook, I had coffee with you, and then we had a phone call, and now I said, oh, by the way, I'm raising money. So 3 documented contacts before you talk to them about raising money, all right? So that's the rules for 506B. So now with 506C, you can put it out there. Those are the ones that you get in your email. I don't know how many of you get email that says, hey, we got this syndication, it's opening up. It's a great multifamily in the middle of Texas, right? So those are all 506C, and they can send those on email blasts. They can put them on the TV commercials about them, whatever. So also reporting. So no ongoing federal reporting is required, and there are filings required under 506B. Okay, Form D has to be filed. Okay, with the Fed, which all it says is I'm raising money for an unregistered security. I'm raising money. That's all it says. Basically, you can do it online on the SEC website. It's just a quick online form. Boom. The thing that I didn't realize, and I'm going to talk about this, is every state that you raise money out of has to be notified also. So, yeah, those are called blue sky filings. Yeah. So, and it's the same thing for 506C. All right, so let's talk about definition of an accredited investor. So, it can be either financial criteria or income, right? So financial criteria, if you got to have $1 million in net worth. That $1 million can count everything, including retirement accounts, investment properties, equity that you have in investment properties. The only thing that you cannot count is your personal residence or the mortgage against your personal residence. Neither of those count in the calculations for your net worth when you talk about for this. Or then you can have income requirements. Income requirements is that you must have it made at least $200,000 for the previous 2 years and expect to make $200,000 for the next year. Unless you are married and you file jointly, then the number's 300,000. 300,000 for the previous 2 years. Expect to make 300,000 for the next year. Okay. So that's your definition of accredited investors. There are some people, like if you hold a license from FinCEN, is it FinCEN or it's the licenses that let you be a financial advisor in like the series.
Yes.
Those Series 7, Series 9, Series 62, those can automatically qualify you as an accredited investor. Also, if you are a fund manager, you count as an accredited investor for that fund, not other funds, but for that fund, you count as an accredited investor. So, all right, so non-accredited investors. So 506B provides a regulatory framework that allows non-accredited investors in. They can participate, but they have to show a certain level of sophistication or understanding. And then there's a lot of disclosures that are required. These are things that I did not know about until I started working with the attorney on our fund. So you have to disclose. There's a long list of disclosures that have to be disclosed. But here's the thing: this is what fund managers and securities brokers, this is what they get in trouble with most often for, not disclosing everything that needed to be disclosed. And then people lose money and then they get in trouble. And disclosures can include things like conflicts of interest. It's important that conflicts of interest get disclosed right away. It's important that any chances or the different problems with an investment, a lot of times the licensed brokers, the SEC goes after them first. This is what they get in trouble with most for, is not providing the appropriate number of disclosures. And then especially if you've got non-accredited investors in the deal, non-accredited investors, you have to pay special attention to them and make sure that they understand everything that they're getting into. And then transparency, it's very important that everything is transparent. In our documents, in our operating agreements, it says that anyone that signs on with us has the ability to ask to see all the books, and we open the financial books for them. We have to provide that level of transparency. So, all right. So legal considerations. So federal and state securities. This is one thing I did not understand until we got into funds, and I've actually had to do a blue sky filing now because somebody invested with us from Colorado, and so immediately our fund platform went and did a blue sky filing in Colorado showing that we have funds. I don't know why the Colorado State Department needs to know that their people are investing in a fund that's doing stuff in Florida.
State protection for their citizens.
Probably. And they probably still want taxes too.
Every state requires it.
Yeah, you're right. Every state does require blue sky filing. So if you're raising money individually for something that you're doing here, and you don't have a fund, and your brother-in-law who lives in Arizona says, "Hey, I'd like to put $50,000 in on that." Technically, you're supposed to do a blue sky filing, which costs about $50, I think, in the state, in Arizona, to let them know. So, and then a PPM, a private placement memorandum. Our PPM for our fund is about, let's say, it's about 35 pages long. And it talks about what we will use the funds for, how we will use the funds. It talks about the bio of all the fund managers. And then it has that takes about 5 pages. And then it has about 30 pages saying all the different ways you could lose all your money. Because all of this talks about that all the time. You can lose all your money. But it definitely goes through the risks, has risks and conflicts of interest, and those are big. And so, and then it talks about that you have the ability to view the financial statements at any time. And then we have to do what's called the subscription agreement. So in the subscription agreement, that goes down. It's actually sort of a questionnaire that says, do you understand what this fund is for? How do you know it? What have you learned about that? And it really goes through a questionnaire, making sure that the person that's signing understands what it is that they're signing. And then, and make sure that they understand the terms and conditions, and it also makes sure that they know that they could lose all their money. Yes, thank you. So And here's a big one, and this is what a lot of people don't understand. And let me tell you why I actually developed this this class, if you will. I was in a mastermind. It was actually Larry Steinhaus's mastermind. I was sitting in his mastermind. It was online, and Larry Steinhaus was the guy that was supposed to speak tonight, and I usurped him. So, but we were in Larry Steinhaus mastermind. There was this guy on there, and he was like, "Hey, let me tell you about this investment opportunity that I've got. We're guaranteeing at least 18% returns." And Larry and I both unmuted at the same time. I was like, whoa, hold up, brother. That's illegal. Okay, you cannot guarantee returns. Okay, that is because it's what you could lose all your money, right?
Yeah.
So if I guaranteed a certain return, then that's a lie. You know, I cannot guarantee a return. So you can't guarantee your returns. Another thing was we asked him. Now here's the thing. So I messaged him. I'm like, bro, get on my calendar, and I'll explain to you what you're doing wrong. He got on my calendar. We started talking. And it turns out he was raising money for a $35 million deal down in Miami. And I said, so you're raising money for this deal? You're not the operator. He's like, no. I'm like, okay, well, number one, that's illegal because that's selling securities in somebody else's deal, and you have to have a broker's license to do that. So I didn't realize that because someone had asked me to raise money in their deal before too, and I didn't realize that they couldn't do that. I don't think they did either. But so then he said, well, is it okay if I have my father-in-law, because this was his father-in-law's deal, contact you? His father-in-law got on my calendar, and I said, bro, tell me about the deal. Okay, how are you going about raising money? Well, I'm just raising money the same way I've always raised money. I just put it out there, and then people come to me and bring me money. I was like, what's the biggest deal you've done up to now? He's like, $4.5 million. I was like, okay, well, this is a lot bigger deal. And do you know what a 506B or 506C is? He's like, no. He had no idea. And I said, do you have a PPM? He said, no. I'm like, do you have a subscription agreement? He said, no. I'm like, bro, you got to call an attorney because you're going to get in trouble, really. Because a deal this big, that's going to raise eyebrows. And so, I advised him that he needs to get with a securities attorney because that's what he was doing. He's selling securities. Now, we all sell securities. If you're doing real estate deals, most of us have been selling securities. We may not know that we're selling securities, or we may not have been aware, but most of us are selling securities. The only time that you could be considered to not be selling a security, does anybody know? If you're raising money into a deal?
When you're raising from just one person.
One person, and you're giving them a mortgage, right? That's a loan. Okay, that's a secured loan. But if you raise from two people for the same deal, now you're selling securities. So that's and there's a thing called the Howey test that we'll go over, and it'll show you what that looks like. So and then the record keeping and reporting, these are all really important about if you're raising money legally, making sure that you've got those records and that you're communicating with your investors and that you're recording those communications. So this is one of the things. This is how like we use a fund platform that does all of this for us. So we communicate with the investors on the fund platform. We put out, this is what we're doing with the fund. This is what we've got going on. These are the updates on the project, that kind of stuff. And so it just keeps a nice, neat, clean record of all of those communications. So keeps all of the paperwork, everything's there and open for people to look at. So conclusion, many investors are taught to raise money the wrong way because they've never heard of Reg D. These are investors, there's investors who've been doing this for 30 years, never heard of this stuff, okay? They never looked into it because someone just said use other people's money, so they did. And it's okay. I'm not saying you've got to change everything that you're doing. Just be aware because there's 4 types, right? And you can't be the one that now you know, so you can't say you don't know. Now you can not care or fool yourself into thinking it doesn't apply to you. But here's a couple of terms to Google or put into ChatGPT, and it's just some of these SEC cases, SEC versus CapSource. The Wells Real Estate Investment LLC was actually a guy down in Miami, and they raised a lot of money. The PIC Renegade Properties was actually, they were doing everything right, except they had four people in their fund. It was a 506C fund that were non-accredited. and they ended up getting a bunch of fines, like $600,000 worth of fines, just for having 4 people that could not verify accreditation status. So this is the Howey test. So they came up with this back in 1930s when the securities, SEC, securities, all that stuff was put together. All these laws were put together. And the Howey test basically says, this is how you tell if it's a security or not. Because they don't care what you call it. The SEC doesn't care what you call it. It's how are you treating it, right? So is there an investment of money? Is it a common enterprise, joint venture, or more than one investor? Is there an expectation of profits? They expect to get money back on top of their money. And is that profit coming from other people's efforts? In other words, not theirs, right? If it says yes to all 4 of those, then SEC considers that a sale of securities, okay. Right? So now we hear this all the time. What about a JV? You've heard the term capital partners, right? Oh, we're just going to set up a partnership, and this person's going to bring money to the deal, and this person's going to do all the work, right? Guess what? SEC says you're selling securities. Howey test, right? Is there an investment? Is there an expectation of return, right? Is there a joint venture or a collection of investors? And is one person making money off of the efforts of someone else? Okay? So for it to be a true partnership, everyone has to have a job. And the job can't just be, I brought money to the deal. Okay? So now, could you have one person, their job is investor relations, and they are bringing money to the deal, but also doing all of the investor communication, keeping track of that, making sure that all of it gets, a quarterly newsletter goes out, something, yeah. Okay, you can have something like that. But everyone has to have a job if they're in a joint venture. And just saying I brought money to a deal, the SEC considers that as the sale of securities. So this is why funds get structured. This is why funds come about. It's to help people raise money legally. If you're doing a whole bunch of operations, then it might be advantageous for you to have a fund. All right. There's 10 to 12 different structures that you can have in funds, and there's funds that aren't even real estate. And we're just talking about 10 to 12 different structures you can have for a real estate fund. You've got all the fund. S&P 500 is a fund, right? It's an index fund. You've got all the different funds. You got funds for trading oil and gas. You've got funds for commodities. You've got a fund just simply means you're pooling investors' money together to invest it so you can invest in bigger deals together. That's all a fund is. But the 2 typical ones that we use in real estate are either syndications or debt funds. All right. So I'm just going to show you a little bit about. Now these are the steps for developing a fund. We found that it takes about 6 months to get all of this in place. We actually started our fund in January. We were not ready to start raising money until June. And this is a sort of latter part of June. So we've really just gotten started raising money for our fund. And so all of this takes time, and it takes money, and it takes lawyers, and it takes fund platforms, and all sorts of advisors and coaches and stuff. So it's not a cheap proposition to get a fund started. So debt funds versus syndications. So how many of you are familiar with syndications? Okay, a few of you. Anybody ever invested in a syndication? Yeah, a lot of times you get that, yeah. So that's like they've got, and usually that's a deal-specific thing. We've got a 120-unit ground-up build in San Antonio, Texas. It's going to be apartment buildings, blah, 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 blah. It'll have 50 pages, and it'll tell you all about the deal. You can buy into it. Minimum is usually $50,000. It'll say either accredited investors or some non-accredited investors accepted, and your money is tied up. How long was your money tied up for in a syndication?
I don't know. I was in one that was 3 years.
3 years? So 3 years is actually short. Normally it's 5 to 7 years is your money will be tied up for 5 to 7 years. Sometimes you can withdraw. Sometimes they don't offer withdrawal ability. Okay. Now here's the thing that's nice about syndications. Syndications, you own the building. So if there were 100 investors, right? And you might have a 100th share of that building. But with that, now if that's a $20 million building, that's still significant, right? And so with that is the amount of money that you invested. Also comes things like depreciation, appreciation, all the ways that we make money with real estate, right? Cash flow from the rents, maybe, you know? And then at the end, when they sell out, that's when you get the big payoff, all right? So a syndication takes a long time. It's one deal, and you have ownership. So one of the problems with that, though, is if things start going south, like they're doing right now in about $7 trillion worth of syndications that are all coming for refinance this year, then you also get things like capital calls. You might know what a capital call is.
We need more money to keep this deal alive.
Exactly. This is your share, and if you don't get us some more, the deal could die, and you could lose everything, just like all the paperwork said. You could lose everything, right? So that's so syndications will do capital calls when they get into trouble. Now, contrast that with a debt fund. Oh, and a syndication. Syndications do usually have payouts, but usually there's this period of time that it doesn't. All right, that's called the stabilization phase. In the stabilization phase, that's when they're doing all their fixing and getting units ready to be rented and rehabbed and all that kind of stuff. So sometimes you won't see a dime out of that investment for 6 months, a year, maybe more during the stabilization period before you start getting your first payouts, and then you start getting a portion of the rents. Okay. Contrast that with a debt fund. Debt funds usually start paying out right away, because what is a debt fund? A debt fund is simply interest only. You're putting money into a fund, they pay you back interest. Okay. And then usually the fund is used to source loans into, so a lot of debt funds are doing like hard money lending or lending into projects and things like that. So capital calls in a debt fund don't happen, right? Because they're just doing loans to get a higher level of interest than what they're paying you. So that's how a debt fund makes its money. So if a debt fund is paying you 12, the lender or the borrowers are actually paying the debt fund probably 13 or 14%. And the debt fund makes its money with the arbitrage of the different interest rates. Okay, so we're just lending money, so we're not doing capital call. But usually the debt funds are open ended, so you can put money into the debt fund. You know, you say you got $100,000 in there, you want to put another $100,000 in there, you can do that. Whereas with the syndication, you got $100,000 in there. Well, the offering's closed, no more. You can't put more money in there, right? So. And the risk of loss is lower in a debt fund because your position on the capital stack is lower. All right. Let me see if I think I've got. So let me go to this. All right, capital stack. How many are familiar with this? All right. So syndications. This is what you're buying into. You're buying preferred equity or common equity. Okay. Notice high reward, high risk. Okay. Debt funds, this is where they're at. Senior debt or mezzanine debt. How many know what mezzanine debt is? That's it. It's just a second position. Second position, a second position mortgage on a house. Is if you're doing it on a commercial property, it's called mezzanine debt. Okay, so this is where debt funds operate. Now, this is lower risk and lower reward. The cheapest money that you can get for a real estate deal is from where? From a bank. Exactly. So that's because the banks do this, senior debt. What does a bank always want?
First position.
First position. So that's the senior debt. Mezzanine debt is second position. There are not many banks, but there are a lot of funds that will do mezzanine debt, okay, which is a second position loan, right? But then the equity. Now here's the thing. In a good syndication, these guys are going to make a lot of money. A lot of money. Sometimes 80, 90% of what they put in. Wait 4 or 5 years, and you're going to get it all back plus 80 or 90%.
And when you mentioned earlier about this, the exception to securities, one mortgage, one lender in the deal, what if there is a bank in the deal and a second mortgage from a private lender?
That's not considered selling a security because the bank is an institutional investor, and they're in a different than from raising private, because we're talking about raising money from private citizens. So that's separate.
I thought so, but I just wanted to be clear.
Yeah.
Primary knows that you've got a PPM for the deal.
Mhm.
That's why they're approving it.
Yeah. So there's less reward here, but also less risk. So get back here. So investor concerns in today's market, what do we see? We see a lot of instability in the markets. You know, Trump came in, there's tariffs, now there's not tariffs, now there's tariffs again, now there's not tariffs, and the markets are doing this, right? What? All fine and dandy if you know how to make money in that, but a lot of the buy and hold investors in the markets are getting sick of that stuff, right? Then recession fears. Everyone knows we probably are in a recession already. You never know you're in a recession until they look at it. You guys know that, right? It's always a backward-looking stat. They go, oh, yeah, there was a recession in 2012. They didn't tell us that till 2013, right? So recession, we're probably in a recession. Of course, we got the rising expenses. We've got the tariffs coming onto stuff from Canada. We get a lot of wood from Canada. So how's that going to happen, you know? And then the debt maturity wall. Right now, that's what I was talking about. $7 trillion in commercial real estate has to be refinanced in the year 2025. I don't know how many of you understand how commercial loans work. Most commercial loans go for 3, 5, or 7 years. Okay, if you're Freddie Mae or Fannie Mac, Freddie Mac or Fannie Mae, yeah, one of those, which are called agency loans, you can do 10 years. But that's the only commercial loans that go that long. Most of them are 3, 5, or 7. So people that were picking up commercial loans for multifamily properties back in 2022, when the market was hot and the loans were coming in at 3%, are now having to start refinancing. What's a commercial loan go for today? Anybody know? 7.5% or 8%. It's more than double what they had the cost of that capital before. That's killing deals left and right. So what are they doing? Capital calls. Sorry, I didn't mean to shine that in your face. Capital calls, exactly. So,
Private.
yeah, exactly. Private. So with a debt fund, you get predictable cash flow, you get downside protection, you get lower volatility. And so this is why right now at this time, Alchemist Nation, we decided that we need to go with the debt fund, as it's going to be what more people are looking for, we think. So again, AGIF has steady cash flow, interest rates of either 7, 9, or 12%, risk management, a lot of transparency and flexibility. And then we don't do asset management fees for investors. All we do is we charge the borrower. You know, we take points. And this is something that we were looking at. Even Merrill Lynch. So this is Merrill Lynch 1. This is their recommendation. Now these are funds from the stock, but notice how much that they recommend is in debt. Okay, debt is down here. Those are bonds. Okay. If you're a stock market investor, the debt is bonds, right? So this is what their recommendations are based on how aggressive. This is super aggressive, 0 in debt, okay? And then as you get further down, very conservative, they recommend up to 71% of your portfolio in debt, okay? So that's just what the financial advisors are talking about. So our current environment is a lot of risk. A lot of syndications are having trouble. Debt funds, we offer an ability to add that to a portfolio, provide some cash flow to people's portfolios, and help avoid the pitfalls of capital calls. And then our structure, focus, and management are designed to provide transparency, security, reliable income. Key is you have to be an accredited investor. Accredited investors only with our fund. So we'd love to have a conversation with you if you're an accredited investor and you're interested in adding debt to your portfolio. Also, I'm happy to book you on my calendar if you're interested in raising capital and you want to know how to do it right. If you want me to get you with a fund platform to help you put things into a fund, I can definitely help you with that kind of stuff too. Any questions?
Why don't you tell them how much it costs them for PPM?
It depends. You can find some lawyers that will do it for as little as $5,000, maybe, but it'd be hard. I've heard of people doing them for $5,000. I don't know if they were lawyers or not, but ours cost about a little over 10, but our lawyer had an agreement with our fund platform, and signing on to the fund platform cost us over 20. And so I don't know how much of that went to the lawyer or not. They said it was around half. So, but yeah, and the nice thing about the fund platform that we're with, Investor, is we only have to have one PPM, and we can put multiple deals under. So now with each deal, it's called a convertible fund. And so I can make one PPM. It was actually Vinny Chopra that told us about this platform, because Vinny's like, I've wasted so many hundreds of $1,000s on PPMs. And setting up a new PPM. Every time he did a different deal, he had to set up a new PPM. So now you get one PPM, and then each deal that you put into the platform, you have a separate deal disclosure. So, and basically the deal disclosure says, now in addition to the PPM, these are the other things you need to know about this deal. And here's the specific risks to this deal. Here's the specific, here's any particular other things that you need to know about, any disclosures. That was the word I was looking for, disclosures about this deal.
Like, Walter's acquiring a property, he's got something under contract right now, but he hasn't closed yet.
Right.
So you're raising money to make that happen.
If we were doing equity in some of those deals, yes.
Yeah, but if you're raising money because you're planning to loan it to somebody to make that happen, and then the deal they were doing falls through, do you take the money prior to the deal being in place, or if I was an investor, am I pledging the money only if this deal becomes
No,
closed?
yeah, no. So the debt fund, and you'll also hear debt funds called a blind fund. It's a blind debt fund. So it's not dependent on a deal on the other side of it.
So it's on you guys to make sure you're reinvesting it in something that will turn a better return.
Correct.
If the deal you thought you were going to make happen didn't happen,
Correct.
you could be losing money while you're putting another deal together.
Yep. Yep. So, yeah, a debt fund is actually more complicated than syndication, and it actually required us to create another entity. We actually had to have, most syndications only require you to have two entities. You've got to have the management team and then the syndication deal, the syndication entity. With a debt fund, we had to have a third entity, because the third entity is actually the one that sources loans and holds the assets. And then the line of credit between the debt fund and the capital entity is secured by the assets of the capital entity. So promissory notes or mortgages or equity positions that the capital entity owns is what's securing the loan between the debt fund and the capital entity. So yeah, that was, it's hard to explain without writing it out on paper. It was hard for me to understand too. I'm like, why have we got to do this? What? And they kept explaining it to us, but yeah, so.
You said that accredited investors get access to like exclusive deals or whatever, like meet qualifications. How so? Like, can you elaborate on that?
Yeah, like there's some crazy deals that I've seen people get a hold, like oil field deals where you can buy into an oil field. And I have a friend that Brian I think he put $85,000 into an oil field deal, and within a year he had been paid his $85,000 back, and then he just cash flowing after that. There's no deals like that the average investor can get in. You can go buy stocks or go buy crypto and maybe get lucky.
So it's just something you're not calculating, that's why you're investing.
Once you're an accredited investor, yeah, you're the who you know opens up. Yeah. Any other questions?
There's also an assumption that if you have over $1 million, that you're probably educated.
Yeah.
And here it is. Here's the thing. That's a big assumption. And what we're finding is we've found a lot of people who are accredited investors don't know they're accredited investors, just because if you're a real estate investor and you hold 4 or 5 properties and you've got a couple $100,000 of equity in each of those properties, you're probably an accredited investor. That doesn't mean you know anything about the stock market or trading options or doing anything that some of these other funds are doing. So we do a lot of educating folks, and trying to help them and understanding what it means to be an accredited investor and what the investments look like. So, yeah. All right. Well, thanks for your time. Appreciate it. Again.